Benjamin Graham's The Intelligent Investor, first published in 1949, is widely considered the definitive framework for value investing. A bestseller with applicable real-world guide, not hearsay. I made a fortune following the guide. To turn Benjamin Graham's timeless concepts into a practical roadmap, I summarized and paired each of the 20 main points from The Intelligent Investor with a direct, real-world application strategy for today's market. My name is Joey. I explain money, investments, and how they work. Before we dive in, subscribe and give this video a thumbs up as we commence. Number 1. Investment versus speculation. The point. An investment guarantees safety of principal and an adequate return through thorough analysis. Everything else is speculation. How to apply it? Before buying any asset, perform the why am I buying this? Test. If your answer is because the price will go up next week, you are speculating. If your answer is because this company generates strong cash flow and is trading at a discount, you are investing. Number 2. The two types of investors. The point. You are either a defensive investor or an enterprising investor based on the time you can commit. How to apply it? Be honest about your schedule. If you have less than 5 hours a week to read financial statements, build a defensive portfolio using low-cost, broad market ETFs. If you love digging into quarterly earnings reports, 10Qs, set aside a small, separate account for enterprising stock picking. Number 3. Mr. Market and emotional control. The point, the market is an emotional business partner that offers to buy, sell at wild prices daily. You should exploit his moods, not follow them. How to apply it? Delete stock tracking apps from your phone's home screen to avoid checking daily price fluctuations. When a broad market sell-off occurs, treat it like a holiday sale at your favorite retail store. Look for high-quality companies whose stock prices dropped simply because the whole market panicked. Number 4. The margin of safety. The point. Never buy an asset at its full estimated value. Buy it at a steep discount to absorb human error or unexpected bad luck. How to apply it? If your valuation model calculates that a stock's intrinsic value is $100, do not buy it at $95. Set a strict rule to only buy if it drops below $70 or $75. This 25 to 30% discount is your margin of safety. Number 5. Price fluctuations are opportunities. The point. Price drops are good things for buyers, not reasons to panic. How to apply it? Keep a watch list of 10 great businesses you want to own, but find too expensive today. When a market correction or sector-specific downturn happens, use that cash buffer to buy them while everyone else is selling out of fear. Number 6. Inflation and asset allocation. The point. Cash and bonds lose purchasing power over time due to inflation. Equities provide a necessary hedge. How to apply it? Even if you are a highly conservative investor, do not hide all your capital in high-yield savings accounts or short-term treasury bills. Maintain a portion of your portfolio in equities or real estate assets that have the pricing power to outpace inflation. Number 7. The 25-75 rule of asset allocation. The point. Maintain a dynamic balance between stocks and bonds, scaling down on stocks when the market is expensive and scaling up when it crashes. How to apply it? Rebalance your portfolio rigidly twice a year. If your target is 60% stocks and 40% bonds, and a massive bull market pushes your stocks to 75% of your portfolio, force yourself to sell the excess stocks and buy bonds. This systematically forces you to buy low and sell high. Number 8. Dollar cost averaging. The point. Automating your investments removes emotion and ensures you mathematically buy more shares when prices are low. How to apply it? Set up an automatic recurring transfer from your paycheck directly into your investment account on a fixed schedule, e.e., every month. Do not pause this transfer during market crashes. This is exactly when your fixed dollar amount buys the most shares. Number 9. Criteria for the defensive stock portfolio. The point. passive stock pickers must stick to large, financially stable companies with long track records of earnings and dividends. How to apply it? If choosing individual stocks defensively, filter for companies with a market cap above $10 billion, a current ratio, current assets divided by current liabilities greater than 2.0, and a minimum of 10 to 20 consecutive years of uninterrupted dividend payouts. Number 10. Valuation limits for the defensive investor. The point: never pay more than 15x earnings or 5x book value for a stable stock. How to apply it? Use a stock screener to filter out companies trading at exorbitant valuations. While today's asset-light tech companies can skew the traditional book value metric, you can look at a modified metric like a price-to-earnings to growth ratio under 1.0 to ensure you aren't overpaying for growth. Number 11. The enterprising investor's strategy. The point: active investors look for unpopular large companies, out-of-favor sectors, or bargain issues. How to apply it? Look where others are bored or fearful. If a specific industry is facing temporary regulatory headwinds or a short-term cyclical downturn, look for the strongest, healthiest player in that space whose stock has been unfairly dragged down with the rest. Number 12. Net current asset net stocks. The point: buying companies trading for less than their liquidation value in inventory minus total liabilities. How to apply it? While true net stocks are rare in modern, highly efficient markets, you can apply this principle during deep recessions or bear markets. Use stock screeners to search for microcap or small cap stocks where the net cash per share is higher than the current stock price. Number 13. The perils of growth stocks. The point: high growth stocks carry massive speculative risk because their current price depends entirely on an uncertain future. How to apply it? Cap your exposure to speculative tech or high growth stocks without current earnings to a small percentage of your overall portfolio, e.g., less than 5% or 10%. Treat this as your satellite portfolio, while keeping your core portfolio in safer value assets. Number 14. Beware of IPOs and new offerings. The point: initial public offerings are usually sold at peak valuations to benefit the sellers, not the buyers. How to apply it? Implement a strict rule to never buy a stock on the day of its IPO, no matter how much media hype it gets. Wait at least 12 to 18 months for the lockup period to expire, the hype to cool down, and the company to post a few quarters of public financial data before you evaluate it. Number 15. The concept of intrinsic value. The point: a stock has an underlying real value based on its fundamentals, completely separate from its current trading price. How to apply it? Learn to read a balance sheet and cash flow statement. Use a discounted cash flow CEF model or conservative earnings multiples to estimate what a business is worth before you ever look at its ticker symbol or stock chart. Number 16. Stock selection versus market timing. The point: focus on whether the price of an individual asset is cheap relative to its value, instead of trying to predict macroeconomic cycles or market direction. How to apply it? Ignore Wall Street pundits predicting the next market crash or macro forecasts. If you find a specific company that meets all your value criteria and offers a margin of safety today, buy it regardless of what the broader index is doing. Number 17. Rely on diversification. The point: even the best analysis can be wrong. Spread your risk across multiple holdings. How to apply it? If building an individual stock portfolio, hold between 15 and 30 companies across different sectors: consumer staples, healthcare, financials, technology. Do not let a single stock position grow to occupy more than 10% of your total net worth. Number 18. Avoid financial advice from wrong sources. The point: Wall Street brokers and financial media outlets are incentivized by transaction volume, eyeballs, and clicks, not your long-term wealth. How to apply it? Turn off financial news networks that focus on sensationalizing daily market moves. If you use a financial advisor, ensure they are a fiduciary who is legally required to put your financial interests ahead of their own commissions. Number 19. Dividends as a measure of safety. The point: consistent cash dividends prove that corporate earnings are real profits, not accounting tricks. How to apply it? Prioritize companies that not only pay dividends, but continuously increase them annually, often referred to as dividend aristocrats or kings. Reinvest these dividends automatically using a dividend reinvestment plan to let compounding work faster. Number 20. The psychology of risk. The point: real risk is the permanent loss of capital, usually caused by an investor panicking and selling at the bottom of a crash. How to apply it? Before investing a single dollar, write down an investment policy statement, detailing exactly what you will do if your portfolio drops by 30%. When a crash inevitably happens, read your statement to ground your emotions and stop yourself from panic selling your assets at a loss.